6 Ways to Valuing a Company. There are several ways to value a company, and the appropriate method depends on the context and purpose of the valuation. The most common methods are to use market capitalization, price-to-earnings ratio, discounted cash flow, comparable company analysis, asset-based valuation, and enterprise value to EBITDA. 1. The market capitalization method is commonly used to value publicly traded companies. It involves multiplying the company's current stock price by the number of outstanding shares. Using this method, you would first need to find the current stock price. Look up the company's stock ticker symbol on a financial news website or platform, such as Yahoo Finance or Google Finance, and find the current stock price. Then you would determine the number of outstanding shares. The number of outstanding shares is the total number of shares of the company's stock that are currently held by investors. This information is usually available on the company's latest financial statements or on a financial news website. Finally, multiply the current stock price by the number of outstanding shares to get the company's market capitalization. For example, if a company's stock price is $50 and it has 100 million outstanding shares, its market capitalization is $5 billion, $50 by 100 million. It's important to note that market capitalization is not always an accurate reflection of a company's underlying value, particularly for companies that have a small or liquid market for their stock. Additionally, market capitalization doesn't take into account a company's debt, cash, or other assets, so it's important to consider other valuation methods as well. 2. The price-to-earnings ratio, PE ratio, method compares a company's stock price to its earnings per share, EPS, over the past year. A high PE ratio suggests that investors are willing to pay a premium for the company's future growth potential. By using this method, you would need to find the current stock price. Look up the company's stock ticker symbol on a financial news website or platform, such as Yahoo Finance or Google Finance, and find the current stock price. Second, find the earnings per share, EPS. The EPS is the company's net income divided by the number of outstanding shares. This information can usually be found on the company's latest financial statements or on a financial news website. Thirdly, calculate the PE ratio. Divide the current stock price by the EPS to get the PE ratio. For example, if a company's stock price is $50 and its EPS over the past year was $5, its PE ratio is 10, $50, $5. Finally, compare the PE ratio to those of similar companies in the same industry to see if the company is undervalued or overvalued. A higher PE ratio typically indicates that investors are willing to pay a premium for the company's future growth potential. It's important to note that the PE ratio is just one method of valuing a company and should be used in combination with other methods. Additionally, the PE ratio can be influenced by many factors, including the company's industry, growth prospects, and risk profile, so it's important to consider these factors when interpreting the PE ratio. 3. The discounted cash flow, DCF, analysis method estimates the present value of a company's future cash flows by discounting them back to their current value using a required rate of return. Using this method, you would need to project the company's future cash flows. Project the company's future cash flows over a certain period of time, usually 5 to 10 years. This can be done by forecasting the company's revenue, expenses, and capital expenditures. Second, determine the terminal value. The terminal value is the estimated value of the company's cash flows beyond the projection period. This can be calculated using a formula such as the perpetuity growth method or the exit multiple method. Next, you would have to discount the cash flows. Calculate the present value of the projected cash flows and terminal value by discounting them back to their current value using a required rate of return, which reflects the risk associated with the investment. The discount rate is typically the company's cost of capital. The next step is to DDD up the present values. Add up the present values of the projected cash flows and terminal value to arrive at the company's enterprise value. Followed by subtracting net debt. Subtract the company's net debt, which is the total debt minus cash and cash equivalents, from the enterprise value to arrive at the company's equity value. It's important to note that DCF analysis is based on a number of assumptions about the company's future performance and is therefore subject to a high degree of uncertainty. Additionally, small changes in the assumptions can have a significant impact on the valuation, so it's important to be realistic and conservative when making projections. Part 2 of 2, to be continued. Looking forward to seeing you in Part 2.